Welcome to Illuminati Silver. We tell you the truth about silver. Today is Monday the 25th of May 2020, and yesterday we published a video entitled As US-China Tensions Mount, Is Global Recovery at Risk?, where we address the issue as to whether the growing tensions between the United States and China could lead to a further deterioration in global trade already affected by the recent pandemic. We also published our Gold and Silver Weekly Update on Saturday, and we've placed links to both of these in the description box below. Now today it's a bank holiday in the United Kingdom and Memorial Day in the United States, so there's very little trade of consequence going on. But that said, there is still nevertheless a fair amount of information and headlines being published about which we should at least be aware. There was some interesting data published by Germany today, and we shall take a brief look at Reuters, which reported on this just a few hours ago. Reuters article, dated May 25th, 1:46 a.m., updated 2 hours ago. The time currently is 18:46 GMT plus 1. German sentiment survey boosts stocks. Europe focuses on recovery fund. Stocks gained modestly on Monday, with many countries on holiday, as German business morale rebounded strongly in May, offering a glimpse of optimism to battered investors of what lay beyond weeks of economic lockdowns. MSCI's gauge of world stocks gained 0.4%, nearing a 2.5-month high. The Pan-European Stoxx 600 index was up 1.2%. Lockdown measures introduced in mid-March have put the global economy on track for a recession this year. Only unprecedented stimulus by global central banks has held up world markets in recent weeks. With nervous investors wary of adding to their equity holdings over concerns on what a post-lockdown world would look like, Germany's IFO Institute survey for May gave some relief. The index rebounded more than a Reuters poll expected in May, recovering from its worst decline on record in April, as a reopening of Europe's largest economy boosted corporate expectations. The low point of the slump should now be behind us, and there even is the chance for a short-lived strong rebound in the coming months, ING economists told clients. But analysts voiced caution, given the uncertainty ahead from the pandemic, with IFO itself still expecting a double-digit contraction in Europe's largest economy in the second quarter. We shouldn't probably overemphasize the data because we have so much distortions from the virus, said Jens Peter Sorensen, chief strategist at Danske Bank in Copenhagen, referring to difficulties survey respondents may face in evaluating the impact of the pandemic on economic indicators. More optimism came from Japan and Spain. Prime Minister Shinzo Abe lifted the state of emergency for Tokyo and 4 remaining areas on Monday, while the government is also considering fresh stimulus worth 100 trillion yen or $930 billion. Spain also announced it will lift a quarantine requirement on overseas visitors from July the 1st, which may help its tourism sector. In Europe, Italian 10-year bonds dropped to 6-week lows, despite the uncertainty of what a final package might look like, after a group of more hawkish states presented a paper against France and Germany's €500 billion recovery fund proposal. The euro steadied around the $1.09 level, recovering from earlier losses as focus shifted to the European Commission's own proposal that is expected on Wednesday. But with financial markets in Singapore, Britain and the United States closed for public holidays on Monday, market moves were relatively small and held within well-worn ranges. China-US tensions. Global stock markets were also set to make gains, despite signs of renewed strains in Sino-US relations over the weekend. China's move to impose a new security law on Hong Kong has heightened concerns about the stability of the city and global trade prospects, and upset the United States. The dollar, which tends to behave like a safe haven asset during market turmoil and political uncertainty, touched a 1-week high against its rivals in earlier trading, but erased gains in late London trading. Ties between the two countries have deteriorated since the coronavirus outbreak, over which they've exchanged accusations of cover-ups and a lack of transparency. Rising tensions between the US and China around Hong Kong trade policy and who is responsible for the 2020 economic dislocation, are threatening to end the post-March trough rally, said perpetual analyst Matthew Sherwood. Oil prices, which have been driven higher for the past 4 weeks, were steady on Monday, with US crude oil up 0.35% to $33.62 a barrel and Brent up 0.4% to $35.36 a barrel. Spot gold was off 0.2% at $1,730.1 an ounce. End of article. As we can see, this appears to be quite bullish. However, a slightly earlier article published by Bloomberg has painted a slightly differing picture. Let's take a look. Bloomberg article dated May 25th, 2020. Big short in US stocks needs watching, says one market veteran. A large bearish position in US equities that's been amassed by trend following funds may prove vital to the next move for stocks, according to a strategist who's been analysing markets since the early 1990s. The S&P 500 is now trading within 50 points of its 200-day moving average, a metric that's proved important when breached in the past for changes in positioning by commodity trading advisors known as CTAs, according to an analysis from James McCormick at NatWest Markets plc. The firm's signal, which tries to forecast changes in flows by replicating what a generic trend-following strategy would do, is near its most bearish level and positioning is at its biggest net short since 2016, he wrote in the report. This level is certainly worth watching, McCormick, the firm's global head of desk strategy in London, wrote. End of article. Now, just to confuse everyone, let's now listen to an article published by Mark Hulbert on MarketWatch, which was also published today. MarketWatch article dated May 25th at 12:12 p.m. ET. Opinion, Hulbert. My stock market forecast for June is likely wrong, but watch out for August. Over the next 3 weeks at least, it's unlikely that the stock market will break below its March 23rd lows. In fact, the S&P 500 is more than 30% higher than where it stood at that bearish point, for example, and the Nasdaq Composite is up more than 35%. A 3-week decline that wipes out those gains would be extraordinary. The reason I bring this up is because of renewed interest in column 1, wrote in early April. In the report, I ascertained that based on the average lag time between the VIX's peak and the bear market's eventual end, that low would occur on June 14. I'm not holding my breath, and I'm sure you're not either. Can we learn any lessons from this experience? One is to be reminded yet again that financial markets are never 100% predictable. Randomness, luck in other words, plays a huge role in the market's shorter-term gyrations, no matter how compelling an analysis might otherwise be. Overconfidence is a vice. This episode reminds me of a famous saying from Josh Billings, a 19th century humorist. Quote, "The trouble with most folks isn't their ignorance. It's knowing so many things that ain't so." Unquote. In my defense, I'd plead nolo contendere. Another lesson is that it's never the case that the data all point to the same precise conclusion. For example, in that early April column, in which I suggested that the final bear market low could be June 14th, based on the VIX, I presented another historical parallel that points to a final low on August the 7th, based on the number of days between the end of the bear market's first precipitous drop and its eventual end. This other analysis was equally plausible and just as solidly based on historical data. The jury is still out on that forecast. Still, the investment implication is that we should focus on the weight of the evidence rather than just one indicator, no matter how compelling. Some of you have suggested that I draw another lesson. The reason the market bottomed out so soon after the VIX peaked was because of the US government's extraordinary stimulus that it enacted in mid-March. I'm not so sure that's the correct lesson. Consider each of the bear markets since 1990 in the calendar maintained by Ned Davis Research. As you can see from the accompanying chart, the VIX's peak's lead time in advance of the lows of those bear markets range from 0 days, in the case of the 1998 bear market that coincided with the collapse of long-term capital management, to 171 days in the case of the 2015-16 bear market. Try as I might, I can find no correlation between the length of this lead time and the speed and magnitude of the federal government's response. So, what's the bottom line? The lessons of history are never easy or straightforward. My best guess is that US stock prices will pull back in coming months, but the March 23rd lows will hold. I gave reasons for this expectation in a column earlier this month, but I'm prepared to be wrong again. Mark Hulbert is a regular contributor to MarketWatch. End of article. So, what conclusions can we draw from these three articles? Well, of course, the obvious one is that no one really knows precisely what is actually going to happen. However, one can perhaps draw the conclusion that the level of stimulus injected into the system, into the economic system, will help a number of firms not only survive, but also to some extent to prosper. Yes, with zero or negative rates, the banking industry, however, will suffer, but many other business types will simply excel. We've often quoted that the chickens will eventually come home to roost, but that time may not be today or tomorrow. This is why we have heralded caution and moderation. The effects of such high degree of money printing will be economically advantageous short term and potentially damaging medium to long term, but that could still be a year to 3 years out. That is why we frequently guide that if you're of the opinion that precious metals, and especially gold and silver, are the solution to potential economic woes or currency devaluation, then just simply bear in mind that it could very well take some time before that solution fully materializes. Now, with so many markets closed today, we cannot glean much from any market movements particularly. But it's interesting to note that gold is down so far by $6 at $1,730, and silver is up just 1 cent. We are, of course, expecting more exciting moves when the weekly jobless claims are announced on Thursday, and a host of additional US economic data is announced on Friday. But meanwhile, do share your thoughts on what your opinion of particularly equity markets are. Do you think they are more or less at the sort of level they're likely to remain for a while? Do you think they're going higher, or do you think they're going lower? It'll be interesting to see how many of our subscribers choose one over the other. Meanwhile, thank you so much for listening. If you haven't already done so, please subscribe to our channel and press the bell sign so that you're notified of our videos as and when they're published. Not forgetting that we frequently upgrade the Richard and Greg channel, and an additional video will be appearing on that in a couple of hours' time. We hope you have found this video interesting and informative, and if so, please give it a thumbs up and share it on social media. Please ensure that you have subscribed to our channel and press the bell sign so that you are notified of any future videos. Also, kindly visit our website at illuminatisilver.com, and if you haven't already done so, please subscribe either as a free or paying member for regular email updates and offers. Disclaimer: Illuminati Silver owners come from a background of banking, international wealth management and economics. Having now retired from these worlds, we are not qualified to give investment advice. Therefore, this and other productions must not be deemed to be giving such advice and merely represent the personal views of its owners.